What if that low delinquency rate you keep hearing about is the distraction, and the real crisis is on a timer? CMHC says 1.2 million renewals in 2025, with roughly 1.05 million at significantly higher rates and an average 30% payment jump. Auto loans and credit cards are already flashing red. Stay here and I'll map the timeline, where the stress shows up first, how it hits mortgages next, and what move protects you before the wave breaks. Before we move on, please take a moment to subscribe to the channel and like the video. You're staring at a calm ocean. Mortgage delinquencies look tiny, almost boring. Headlines say stable, feels safe, right? But the swell is already rolling in from offshore and it has a date on it. Here's the thing. By historic standards, the rate is still low. Not 2019 high, not crisis level. That's the bait. The drift isn't down anymore. It's up, not a spike, a grind. You can miss a grind because it doesn't scream. It just keeps ticking while everyone quotes last quarter's victory lap. It's real, it's happening. The timer is 2025. That's when the renewals hit its scale. The warning is simple. Delinquencies start moving before they trend, and they're moving. You don't need a red siren to know what a clock sounds like when it's at 11:58. The calendar is the enemy here, not today's chart. But here's the catch. Around 1.2 million fixed-rate mortgages roll next year. CMHC says roughly 1.05 million of those renewals land at noticeably higher rates even after rate cuts. That's not doom content. That's arithmetic. If you locked in when money was practically free, you're graduating to normal at the worst possible moment, after groceries, insurance, and taxes ate the cushion you thought you had. So, let's make it real. CMHC pegs the average payment jump at 30% on renewal. That cute $2,000 a month becomes $2,600. Same house, same family. $600 more every month, every year. That's a used car payment stapled to your mortgage. You don't negotiate 600 with vibes. It's 600 with vibes. You need income or cuts. And cuts usually mean something you like disappears. It's like thinking your gym is $29 forever. Then the promo ends and it's $39 plus 5 weird fees for towel service, maintenance, and air. With a mortgage, the promo never comes back. There's no New Year special. It just stays heavier. The only discount is if your income grows faster than the reset, and for most households, it didn't. The pain isn't the headline policy rate. The pain is the gap. Pandemic mortgages were priced when the floor was basically a trampoline. Today's rates aren't extreme by long-run history, but relative to ultra-low, they're a cliff. And that cliff gets steeper because principal sizes ballooned in the boom. The bigger the loan, the nastier the reset. You feel it in real dollars, not percentages. CMHC calls it a sticky upward trend. Translation: it doesn't fall back just because the central bank shaved a few basis points. The projection is blunt. Arrears could drift back to pre-pandemic levels by late 2024 or early 2025. That doesn't mean mass foreclosures tomorrow. It means the base you're standing on is crumbling in slow motion while everyone debates whether the pebbles count as rocks. Here's the mini payoff. The stability on your screen is lagging data. The risk is scheduled. The headline isn't lying. It's late to the party. Renewals are a conveyor belt. People step on, costs jump, the stats react months later. So saying delinquencies are low right now is like bragging the smoke alarm is quiet while you preheat the oven to 900. So where do the first ripples show up if the wave is offshore? Not in mortgages. Mortgages get protected until the last possible second. The early wobble shows up in the stuff people let slip first, the payments that don't come with a roof and a realtor. That's where the stress leaks before it hits the house. And once you see those numbers panting, you know the beach is about to get interesting. You want the insider tell? It's not MLS charts or median sale price. It's the car payment wheezing and the visa minimum creeping while you swear you'll catch up next month. That's the early siren. Mortgages sit in a glass case marked break last. Everything else is expendable. Households protect the roof at all costs. You miss Netflix before you miss the lender. You let the card float before you mess with the house. That's why non-mortgage credit shows the wobble first. It's the financial version of a check engine light. Annoying, easy to ignore, but very clear about where the engine is heading if you keep pretending the noise isn't there. So here's the thing. CMHC shows auto loan delinquencies jumping from roughly 2.11% to 2.42% in a single quarter in 2024. That's not a rounding error. That's acceleration. Credit card and line of credit delinquencies climbed through the first half of the year too. Separate lanes, same on-ramp. People are running out of slack, and they're choosing to protect the mortgage while the revolving stuff takes the hit. Let's break it down with a normal budget. You got a 3% raise? Cute. Groceries ran 6. Insurance renewal added $20 a month. Childcare called and announced a fee adjustment. Phone plan bumped 5. Gas isn't cheap, and neither is the random school fundraiser your kid brought home. That raise? Gone before it landed. The auto loan gets kicked to the next cycle. Then there's a dentist bill. Now you're 30 days late, then 60. It's not drama, it's arithmetic on hard mode. CMHC flags exactly this pattern as a leading indicator for mortgage arrears. Historically, when the unsecured stuff starts to cough, housing stress follows with a lag, not tomorrow. On renewal. That's the trapdoor. If the card and the car are already redlining before the mortgage resets, you don't have fat to cut. You have a decision tree you won't like. Zoom out. Consumer insolvencies are back near pre-crisis levels and up around 4.8% year over year in Q3 2025. Translation: more people are formally admitting the math doesn't work. Proposals are doing more of the heavy lifting than bankruptcies, which sounds nicer but still signals strain. It's a shuffle, not a solve. Now the twist. A tight housing market can bail you out. You list, you sell, you dodge default. That buffer exists until it doesn't. It relies on steady demand, easy financing, and no policy rug pulls. If too many owners sprint for the exits at the same time, or if lending standards tighten mid-chase, days on market stretches and the lifeboats get crowded fast. And the folks who bought in the pandemic? They carry the biggest principals. That's the cruel part. Longer amortizations can shave the monthly shock, but they stretch risk over more years. You're trading a smaller punch today for a drawn-out body shot that never stops. If you're already juggling cards to float essentials, the runway isn't longer, it's just flatter. Here's the mini payoff. The canary is coughing. Auto delinquencies up, credit cards up, insolvencies rising. If wage growth cools or unemployment ticks up even a little, that stress doesn't vanish. It migrates right on schedule into mortgages at renewal. It's like a stadium wave of missed payments, section by section, row by row. So what do you actually do before renewal season hits and the clock strikes midnight? You don't wait for the mortgage statement to land. You front-run it. You pull the terms, you model the hit, you triage the debts that are already blinking, and you get on the phone before everyone else floods the line.